Today we're going to go into money. Specifically, we're going to talk about stock selection. So stay tuned. Okay, so this is Big Five Sporting Goods. In my opinion, I think they're a good stock to evaluate. I like the price at 11 bucks. But I also like the fact that out Southwest, they have a pretty good presence, and I like the customer service and products that they had when I purchased from them. I haven't seen them go east, or at least evaluated them enough to know that they are in the East Coast or Midwest, and so that's why I thought it would be a good one to review. So let's get to it. Okay, so I've taken some time to get this on the screen so that you guys could see it. On the left, I have a one-page quick analysis, and these are the questions I'm going to ask to determine whether we should go any further with purchasing, or at least analysis of purchasing this particular stock. On the right, I went and I got information from Morningstar.com on Big Five Sporting Goods, and it should be presentable so that you guys can see it, and I'm just going to walk through the data, and on the left, answer yes or no to whether or not we should go any further with this stock. And I should say the quick analysis is from Value Line. So, onward. Okay, so first question, have sales increased continuously for 5 years? Can we look at revenue and we go back the last 5 years? 1, 2, 3, 4, 5. And has it increased 897 million up to 978 million in 2014, and each year it has increased. So we go back and we check here under yes. Have sales doubled in 5 years? Unfortunately, sales haven't doubled in 5 years, although they have increased. So we'll give that a no. Have earnings per share increased continuously for 5 years? Earnings per share, we take a look here, the last 5 years. And kind of up and down. 12.94 in 2010 was 0.94. And in 2011 went down to 0.53. Then up again to 0.69, up again to 1.27, and down in 2014. So we can't give a yes on that one. Have earnings per share doubled in 5 years? Looking back at 0.94 compared to 2014, no. It actually went down, so that's a big no. Have any dividends been paid during the past 5 years? We look at dividends. And yes, they've been paid each year. So that's a yes. Yeah, have dividends continuously increased over the last 5 years? And as we're looking at it, what would be the thing to work with there would be payout ratio. They're basically asking you if the amount of dividends in cash that were paid out to the shareholders divided by the number of shares that were outstanding, if that amount increased over each year. And again, payout ratio is what we're looking for there. So if we look back from 2010 to 2014, it has increased each year, with the exception of 2013. But I would consider, since 2014 picked up pretty much where it left off in 2012, I would say yes to this. Now, there's obviously some subjectiveness that I'm introducing here. And again, as you become more and more familiar or do more stock analysis, you realize there's a lot of variables that come to play that you'll have to determine on your own what's important to you and what's not. But for this particular answer, I think I'm going to give a yes. If we will look back later and we are concerned about that year 2013, we can look and see what the circumstances were then and why they didn't decide to pay out as much in dividends that year. Anyway, moving on, is current operating margin 15%? Operating margin, let's see if we have that here. Here we go. Operating margin for the last 5 years. Is it 15%? Oh, I'm sorry. That's not correct. This is what we're looking for. Let's get rid of that. And operating margin is here in percentage. And it is not 15% by any means. So let's go back. Go back here, and under 15%, no. Over the past 3 years, is OM stable and increasing? Operating margin stable and increasing the last 5 years. And that's a no also. Okay. Is current return on equity 15%? Let's see. Return on equity. Here we have it down here at the bottom. Percentage. Is it 15%? Only in 2013. And you can make the argument to 2010. It was 14.55, so we could round that. But other than that, it actually went down in 2014. So no, it is not 15%. Over the past 3 years, has it increased? And the question is over the last 3 years. And it increased 1, and then it went back down half. So that is a no. Is current long-term debt less than 1/3 of net worth? Long-term debt. Let's see. Okay, to get long-term debt, I had to go back out to Morningstar and get go under Financials tab, and here we have the balance sheet. And I'll pull it down here, and there's the assets totally, and here is our long-term debt here. So I am going to highlight that for the last 5 years. And getting back to our questions, is long-term debt less than 1/3 of net worth? So there's long-term debt, and then the net worth. So net worth is equal to your assets minus your liabilities. And we have here our total assets for 5 years. And here's our total liabilities. But the number we're actually looking for is the difference between the two, which is here, stockholders' equity. So that's our net worth. And okay, so they want to know if the long-term debt is less than 1/3 of stockholders' equity. And I think we're going to take a couple years, maybe the most recent 2 years, to figure this. So I'm going to take 195, I've got my calculator here, times 0.33, and I get 64.35. So in 2014, where the long-term debt was 66 million, it's relatively close. So I would give that a yes. Although they're probably looking for 64 million and below. It's so close that I'm going to say yes here. And just as a check, we'll look at the year before that. We have 191 million times 0.33, and we get 63. And the 43 million that they had in 2013 is way less. So yeah, I'm going to stay with yes for my answer there. Okay, next question. Are current assets twice the current liabilities? Okay, looking at our balance sheet, we go up to find current assets, which is here, total current assets. We'll highlight that. And then our current liabilities. And now they wanted to know if our current assets were twice as much. So I'm going to look at year 2014 here, where it's 164 million for current liabilities, and total current assets is 358 million. So we'll just 164 million times 2, 328, and so the current assets is definitely 2 times as much. And just for good measure, I'll do the year before that also. We have 176 times 2, and that's 352. The year before that, 2013, wasn't as much. It's off by $7 million, but I am going to give a yes to this one. Okay, so does cash plus receivables equal or exceed current liabilities? So going back out to Morningstar to get the cash flow statement and pull that up. Cash plus receivables. I am assuming they mean cash flows from operating income, which is this top line here. So this line here. We're going to do here, I need to highlight that. Okay, cash flows from operating income, and then accounts receivable is here. Again, I'll take the last two. I'm going to take 2014. Let's work with that. And we have 29 here. 1 there. And so we got 30 million there, and then if we go back to our balance sheet, let's see, make sure our question here again, cash plus receivables equal or exceed current liabilities. So we got 30 million versus current liabilities. We've got 164 million for 2014. And so cash plus receivables of 30 million equal or exceed current liabilities of 164 million, and that is a big whopping no. So okay, number 14 is projected growth in EPS and dividends at 15%. Now, we might change our minds in the future, but right now we've decided to do something different with this question because we'd like to stay within Morningstar for our data gathering. However, this question also introduces some estimates that puts forth some subjectivity that we may not necessarily want. So what we did is we went back into Morningstar, and they have a section that is under the valuation tab, and it's called Wall Street Earnings, and that's what we're looking at here. Under here they have their 5-year growth forecast for BGF V, and that's right here, and it's 9%, and we're simply just going to use that percentage, their forward estimate there, and we're going to compare that here, and it's definitely not over 15%, and we're going to use that to say no for this particular answer. If it was over 15%, then we would have given this a yes. Is current PE in the range of past 5 years average PEs? That's number 15. And we're going to have to get another report from Morningstar. I will take their valuation report. And we'll look here. We have price over earnings here. And compared to the last 5 years from 2014 going back, we have 16.1. And then the current is 17.3. That is within the realm of being close. So let's go back to our number 15, and we'll give a yes to that. Okay, so is Big 5 Sporting Goods stock worthy of further analysis? And just looking at our guide here and tallying up our score, we have on the no side, we've got 3, 6, 9 no's, and we've got 6 yeses. So the obvious answer here would be no. We shouldn't go any further with this stock. It doesn't, from historical of the past 5 years, look like a good investment. Now, if you go back to the original sheet, we'd started with, looking at Big 5 Sporting Goods right here. You will see some more information here that you might want to use to determine whether you go further or not. Charts over here showing the last 5 years. Gives a good indication of what the flow has been. There might be particular reasons why there were some ups and downs here that you might want to evaluate. You've got some analyst research here, which looks fairly decent, positive buy long, if you consider those opinions important. And then you've got some headlines here, news that has currently taken place. So, as you go back and you do further research on a company, you might find something that sticks out, or, might just in particularly feel that this is a good stock for you and your buying habits. So thanks, and give any comments that you might have at the bottom, and subscribe to see further information of this sort.